MoneyFarm Robo-advisor for investing full review. Features, strengths, weaknesses. Links to the platform are in the description. MoneyFarm is a UK and Europe-based robo-advisor designed for investors seeking a balance between automation and expert guidance. Unlike fully automated platforms, MoneyFarm offers hybrid investing, combining robo-advisor efficiency with human advisors for personalized recommendations. It provides 7 risk-based portfolios, built using globally diversified ETFs across equities, bonds, and commodities. A key advantage is its tiered fee structure, starting at 0.75% for investments under $10,000 and dropping to 0.35% for portfolios over $100,000, making it cost-effective for larger accounts. MoneyFarm is ideal for long-term investors looking for tax-efficient solutions, offering stocks and shares ISAs, general investment accounts, and pensions SIPs. Portfolios are actively monitored and rebalanced, ensuring alignment with market conditions and investor goals. A major strength is the human advisor access included at no extra cost, which sets it apart from competitors like Nutmeg or Wealthsimple. The platform has a clean, intuitive interface, making it easy to set up and manage investments. New users take a risk assessment quiz to match them with a suitable portfolio. Another benefit is no exit fees, allowing investors to withdraw funds without penalties. However, there are no fractional shares, meaning small cash balances may remain uninvested. One drawback is the £500 minimum investment, which may be a barrier for beginners. Additionally, MoneyFarm does not offer tax loss harvesting, which could limit tax efficiency for high net worth investors. While fees decrease with larger portfolios, they are higher than some passive robo-advisors, especially for smaller balances. Also, while active monitoring is beneficial, it does not guarantee outperformance over purely passive strategies. Overall, MoneyFarm is a great option for UK and European investors who want a mix of automation and human advice, tax-efficient investing, and a flexible fee structure. However, those looking for lower fees, tax loss harvesting, or a fully passive approach might find better alternatives. If this review helped, check out the links in the description for more details.